Okay, good afternoon and welcome back everyone to another edition of the Market Outlook session with Nasdaq. Today we're going to be talking about the current market environment that we're in, which is a higher volatility environment, and how we want to adjust our option strategies or our strategies for navigating this type of market based on the higher volatility environment and how we can actually use that volatility to our advantage. So first of all, I want to welcome everyone to this session. Please, the chat window is open. Feel free to type in your name, where you're from. Would love to hear from everyone here in the session. What I've seen from the last few sessions of doing this is we've seen really people from all over the world joining, and I really want to welcome because all of you from everywhere, because really this is a community and we're here to help you better understand how to navigate the markets and also educate you on the types of products that are available to you for trading these types of markets that you may not be aware of, some of the pros and cons of these products and understanding how they can potentially benefit your portfolio. But predominantly from my perspective today, we want to talk about the volatility and how you can take advantage of the volatility rather than be scared away from it or shy away from it. Utilizing options and utilizing it in a way with limited risk. And I see a lot of people from the States, a lot of people from Canada, but I also see some people from overseas. So thank you so much everyone for joining me on this afternoon, this Monday afternoon. Let's go ahead and get started. Before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are going to discuss during today's session. So I'll start off by talking a little bit about the state of the market volatility that we are currently seeing. How do we measure it? And what are we doing with it? Specifically, how can we harvest this volatility? How can we take advantage of this volatility to do something with it? Then I'll take a look at the current market outlook from a directional perspective. First, we'll take a look at vol perspective, which is not directionally biased. And we'll take a look at it from a directional perspective, and then take a look at some bullish or bearish examples. How you can utilize options to take advantage of this market, regardless of whether you have a bullish or bearish tilt to the broader view, how to manage these trades, and more importantly, how to size these trades accordingly and scale in and out appropriately before we open this up for Q&A here at the very end. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can I take advantage of the volatility in this markets using index options. And the key word here is take advantage. A lot of investors tend to shy away from volatility. When things get volatile, perhaps you take some losses in your portfolio, and this is where we see a lot of people shy away. And this is perfectly normal. We tend to see when bear markets happen, people reduce risk, people try to shy away from risk, and that makes sense. But it's also important to understand that the volatility can be used in your favor in certain ways, and that's what we're here to discuss. It's not to take away from the fact that when we're in a bear market, emotionally, it's a difficult time to navigate. It's very uncertain. You certainly likely have some investments in your portfolio that are taking losses, that are down in their positions, and it's always difficult to navigate during this time. So today, what we're going to help you try to do is think through the mechanics and think through the strategies that allow you to navigate during a volatile market. It's not going to take away from the emotional side of things in a bear market. It's not going to take away the losses. It's not going to wipe away those losses, but it is going to help you create a process that you can use during these times of volatility to have a template as to what to do when things get more volatile. And arguably where we are today is certainly more volatile than where it was perhaps a month ago, but not certainly very volatile relative to some of the extreme moves we've seen over the last year. So this is really hopefully not only to prepare you for the current market, but perhaps more volatility to come and how you should think about positioning for those sessions. So just a quick poll here before we get started. I just want to get a sense for how people are currently looking at the markets. You know, we ended up pretty down at the end of last week. Things are starting to look a little stronger here, at least towards the close today. You know, what's your view here in the broader markets 1 week out? Do you think the markets will be higher? You think they'll be lower? Or you're not? Or I just want to get a quick sense here for the audience. Okay, so almost half of you have voted already, and 59% of you say you think the market's going to be lower. Only 15% of you think the market's going to be higher. And a full 25% of you say you don't know. Okay, so 2/3 of you have voted. So I think that's a pretty good sample size here. So I would say the majority of you believe that markets are going to be lower. A few of you think it's going to be higher, and a quarter of you think you're not very sure. So let's just talk about this first, the second scenario. Markets are lower. 58% of you believe that markets are going to be lower. Generally speaking, lower markets means higher volatility. And we've seen markets fall off a little bit already over the past couple of weeks, but we certainly have seen markets sell off over the past 9 months or so. So we are naturally already in this higher volatility environment. So what I'm going to use here is an index called VolQ. Many of you might be familiar with an index called the VIX, which is the S&P 500 Implied Volatility Index. There's a very complicated calculation to the VIX. VolQ is effectively similar in terms of measuring implied volatility, specifically 30-day front month volatility. The difference is the calculations. Instead of using a whole strip of options, VolQ only uses the at-the-money options, and it's measured on the Nasdaq 100 index versus the S&P 500 index. There's certainly slight differences in terms of the calculation of the index, but largely what it's telling you is what is the market expecting volatility to look over the next 30 days. And we've certainly seen a fairly sizable increase here over the past month or so in vol terms. It was trading in the low 20s, now we're in the low 30s. So we're talking about a 50% increase in vol. But as you can see, as I was saying before, it's nowhere near the extremes that we've seen here over this past year. The highs are well into the low 40s here to the upside in terms of vol terms. So there's still some upside here potentially for vol to spike, especially since 58% of you believe markets are going to move lower. Volatility and the asset prices that it tracks, generally speaking, move in inverse correlation. So as markets move lower, volatility goes higher. So the question becomes, what happens in a more volatile environment? I think it's clear for most investors that in a more volatile environment, you tend to have bigger swings, many times also losses in your portfolio. But how do you actually navigate this? So we'll talk a little bit about strategies for a volatile market. The first and foremost important thing to remember when it comes to option strategies in a volatile market is you have to remember that option selling has an advantage in high volatility environments. And the question becomes, why is that the case? And it's really because volatility is what we call a mean reverting asset, meaning it's not an asset that trends in one direction or another. It just trades around a long-term mean. So when you get too far extreme to the upside, you tend to have big moves to the downside. And then when vol gets too low, you tend to have snapbacks back to the average. Now, right now, we're above average. So whenever you're above average, statistically speaking, you have a higher chance of a pullback than for a continuation higher. That's not to say a continuation higher can happen, but just statistically speaking, you have a higher chance of the volatility environment moving lower than moving higher. And that's why when you're in a high volatility environment, selling options gives you that advantage. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. And arguably, if you learn nothing else from today's session, this is the most important thing to take away from today's session is when things get more volatile, it's natural and understandable why investors typically run away from this type of markets. They don't like to press further risk in this type of market environment, and I understand that. But we'll talk about how to reduce risk. First, we want to talk about what are the right strategies when volatility gets higher. And first thing to do is think about selling, because when things get high, when prices get high, you want to be a seller. When things get low, you want to be a buyer. We all know the term buy low, sell high. So that's where when things are high, volatility is high now, you want to be a seller. Okay, so perfect. The second thing that you might want to consider in a more volatile market is you generally can trade shorter dated options because that reduces the time horizon of your outlook. It's harder to have an outlook 30 to 60 days out when things are very volatile versus perhaps 1 or 2 weeks out when things are very volatile. So you can trade a shorter dated option. You can also trade spreads because that's going to help offset the cost of buying options, and it's going to help reduce the risk for selling options. And that's what we're going to spend a lot of time talking through here today, is how spreads allow you to sell options in this type of market environment, but do so in a way with limited risk. Because when things get more volatile, you can take on more risk. You're also going to collect more potential rewards. So we want to talk about how to balance those two. And then lastly, we tend to find that in these types of more volatile markets, scaling in and out of trades will also be advantageous instead of simply being all in or all out. Meaning, don't just have a single position that you're either all in or all out, but consider when things are high, start selling a portion of a position. If things get even higher, sell another portion of that position so that you are scaling in and out of that trade. We'll talk a little bit about how the products that I'll walk you through today are sized appropriately for scaling in and out. Okay, does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, so now let's talk a little bit about direction. Okay. I pulled this chart as of yesterday's close, so it doesn't include today's chart. Today's chart, largely, we haven't moved too much. We're a little bit higher here on the close, but this is a weekly chart of the Nasdaq 100 index. We see the rally all the way from the COVID lows all the way through the highs that we saw here at the end of last year. We see the 9-month pullback that we're currently in, and throughout this 9-month pullback, we've had a couple of strong rallies. This was the mid-June to mid-July rally that was about 14–15%, and we've seen the decline since then. If we really want to talk about some specific levels, the Ichimoku cloud, the conversion line, continues to act as resistance. The fact that we stayed below that line remains long-term bearish here in this market. From my perspective, on any rallies here into the 12,700 level on the Nasdaq 100 will likely remain the resistance level. Any rallies up to that level, from my perspective, is an opportunity to take a short position in the index, in the specific names within the index, specifically the large ones: Apple, Microsoft, Facebook, Netflix, those types of names, Tesla. Opportunities to take a short position. So that's what I'm seeing from the broader chart. Everything else looks fairly bearish here. The conversion line is below the baseline. You have a bearish cloud. The lagging line's below the cloud. Everything on this chart points at the moment to bearish unless we can get above that 12,700 level. So the risk reward favors to the downside near that 12,700 level. We've gotten a bit of a rally here today. We'll see how much further it can go. And if we look at the daily chart here, you have the break below the cloud model from the end of last week. So from my perspective, a short-term bounce here is still going to likely stall somewhere around the 12,250 to the 12,300 level, which happens to be the bottom of the cloud here. So any rallies we see here for the next couple of days, in my opinion, will likely stall in those types of levels. Those are the types of levels that I would look for reestablishing further shorts if you haven't already established some shorts up here or perhaps up here. But the risk reward pressing new shorts down here is not particularly favorable, in my opinion, because if you shorted down here, the markets would have to get all the way up to about 12,500, 12,600, even 12,700 before you would say my short is incorrect and I would cut my losses. It's just too much risk, in my opinion. You should wait for a further bounce before establishing new short positions. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. So that's just a broad view here of the directional market from a volatility perspective, as well as from an equity perspective. And just a long-term chart here. This is a 10-year chart of the NDX versus the SPX. This is a relative chart, a ratio chart, for those of you that are not familiar, of the Nasdaq 100 relative to the S&P 500. And what you've seen is basically since the 2008 financial crisis lows, the Nasdaq 100 consistently outperforms the S&P over the past 10 years. And we've had multiple tests to this uptrend line in the previous few years. And we've had a test recently, earlier this year, and we're back to retest that level here again. At the moment, until this breaks, my expectation is that Nasdaq will continue to continue to outperform the S&P. We have seen this double top, which certainly starts to show some level of consolidation and pullback here. If this breaks, that is certainly going to be more bearish of the Nasdaq relative to the S&P, but we haven't seen that yet, but we are very close to that trend line. So it is an important chart to pay attention to. But arguably the most important chart out of anything else is this 10-year yield. We've seen 10-year yields press to new 10-year highs. I think 2011 was the last time we saw 10-year yields at 3.5. We're now at 3.5, in my opinion, after the Fed meeting, and likely over the next few weeks to next few months, we'll likely see this continue moving higher to that 3.8 and continue on. This is really what's putting that downward pressure here in equities. I would say all other fundamentals, technicals really don't matter that much given where the Fed is heading. You know, another 75 basis points this week is very likely, another 75 basis points in November, and then another perhaps 50 basis points in December is what the markets are currently pricing in at the moment. So quite a few more hikes, quite a few more aggressive hikes before things start to normalize a bit. And given the data that the Fed is looking at in terms of inflation, certainly some signs of improvement, but clearly a fairly sticky inflation number that we continue to see. And that's largely what's driving the markets here at the moment. So hopefully that gives you a good sense from a directional perspective as well as from a vol perspective, how I'm looking at the broader markets. So I think it's important for us to just discuss, in this type of higher volatility environment, how do you think about adjusting your option strategies to trade this type of market? And more importantly, do so in a way with fairly limited risk, if not completely limiting your risk. And the one thing I do want to point out here is that you can have a bearish view here in the broader markets, but notice that you could have had a bearish view starting from here. And during that time, there were times of real bearishness, there were times of bullishness, there was times of further bearishness, and there was times of fair amount of bullishness. So keep in mind that this can continue to move lower here, but it's not going to be a straight move down, that it tends to be, and what we've seen so far has been a fairly orderly move to the downside, because this is really kind of the market's reacting to the Fed and reacting to inflation numbers, and it's not this kind of panicking sell-off. We have more of an orderly sell-off that we've seen so far. That's not to say that's what's going to happen in the future, but that's what we've seen so far. So in this kind of continuation lower, within that continuation lower, you're going to see periods of kind of bearishness and periods of bullishness, periods of bearishness, periods of bullishness. So we'll talk about all of the different scenarios and how you can play along or trade in those type of scenarios. So the first one I want to talk about is if you think things are going to bounce a little bit. And maybe this week is a good example of that time where things are pretty oversold here. We've had a pretty big sell-off here from that 13,000 level here in the Nasdaq. We've traded all the way down to 11,000. We've had a pretty big sell-off here last week. So perhaps it's due for a bit of a short bounce here. So I'm going to play, and I'm going to cover the full gamut: bullish, bearish, neutral. And this is not a directional view that I'm placing on the broader markets. I'm just showing you the different strategies that you can use in this type of market environment when things are more volatile. So the first thing that really comes to mind, I would say the simplest of the strategies, is selling credit spreads. And selling credit spreads not only put volatility in your favor, but also puts time decay in your favor as well. So that's what you're getting when you're selling options, is you want to align delta, which is the directional view you have in the market, with the vol, which is vega. So as vol is higher, you want to be a seller of volatility. That's what a credit spread allows you to do. And then also it's short theta. So you also have time in your favor. So you really have three of the primary Greeks all working in your favor if you get the directional view correct in a credit spread. So let's say you're playing for a short bounce. Here's an example that I found earlier today before the market opened. Going out to October 14th, which is 26 days to expiration, selling a 50 delta put at the time when the markets were around 118.61. I was selling the at the money put, which is the 118.5 put. And because when you just outright buy a put option, you're taking on substantial amount of risk. One way to reduce that risk is to buy back a lower put. That's what a credit spread is. So you're selling an at-the-money put option or a slightly out-of-the-money put option, and you're buying back a further out-of-the-money put option to reduce your risk. Here you have a max gain of 272 and a max risk of 578, but you do have a probability of profit greater than 50%. So this is your kind of base case bullish short vol trade that you can place on an index option like the Nasdaq 100. We'll talk a little bit about the sizing of the index options that you have at your disposal and kind of what are the benefits of using an index option versus using an ETF option, like we'll discuss here in a few minutes. But this is the core strategy that you would take in a higher volatility environment if you were playing for a bounce in this type of market. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. This is a pretty standard credit spread. We're going out usually about 45 days, but because things are more volatile, we're going to use a shorter dated option, but you're always going to sell an at the money put option and buy back roughly a 25 delta put option, which in this particular case is the 110 put. And the rule of thumb here is that you want to collect roughly 1/3 of the vertical width when you can on a trade like this. And that's exactly kind of what we're doing here with the bullish credit spread. And then next, what I'll do is I'll look at a bearish credit spread, which arguably is just the mirror image of what we did, right? So this is something what you would do when things bounce a little bit, right? So when things start to bounce and they're starting to hit some resistance levels, you would want to take a look at selling a credit vertical spread. This, if let's say we had bounced a little bit and you wanted to sell that credit vertical spread, I would do something similar in terms of going out to the October 14th expiration date. And I would sell an at the money call option now. And because we're trading around 118.5, I would sell the first out of the money call option, which is the 119 calls, and buy back a 125.5 call against it. So same thing, 25 deltas. And here's the thing, right? You want to use a mechanical approach to selecting these types of strategies. When things are more volatile and you're getting a little bit more emotional, especially if you have some losses in your portfolio, I tend to find that this is really where many investors make some of their worst decisions. And that's where having mechanical set of rules that you use in bull markets and bear markets and in any market, it remains the same. This takes the emotional aspect out of trading. And that's probably arguably one of the most difficult things to do. It's easier said than done, but the only way that you have any shot at being more mechanical in your trading and being able to take advantage of volatility like the one that we're showing you here today is by building that mechanical strategy so that every single time you go to sell a credit spread, you're always looking at the at the money call option and selling and buying back the 25 delta. Some of you like to adjust different deltas. Some of you like to adjust your expiration dates. But the most important thing is to have a process every single time that you stick to it day in and day out. That's more important than which specific expiration dates you choose and what strike prices you choose, if you choose the same one each and every single time. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. And it just happens to be at the current moment that a call credit spread, meaning the bearish credit spread, has a far better risk to reward ratio than the put credit spread. Now, this comes down to the skew of the options, meaning right now to buy this 125.5 call option to reduce my risk is quite cheap. And that's why we see that the 125, the risk to reward on this particular trade is far better on the bearish side than it is on the bullish side. Right now, if to buy the put option here, to buy this 110 put is extremely expensive. Given the market conditions, that's not surprising. So what you really have to pay attention to in selling credit spreads is not just the implied vol, but also the skew of the option. So that's just something to be aware of for those of you that have a little bit more experience trading options. So that's kind of the shallow end of the pool when it comes to how do you take advantage of a more volatile market when you have a bullish or bearish view within that kind of volatile market. You can apply this to any market. You can apply this to any instrument, on a stock, on an ETF, on an index. Today, we're going to talk about indices because there are some additional advantages that you get with indices I'm going to talk about here in 1 minute. But what I'm showing you here today, you can apply to any underlying security. So next, I want to talk a little bit about your portfolio, right? So when things get more volatile, when things are starting to turn south, you're likely seeing some losses in the stocks that you hold and the ETFs that you hold, and you might be interested in protecting some of those losses. especially if you think markets can continue moving lower and you don't want to sell those securities for whatever reason. Maybe you own them for dividends and you need the income, or these have low basis and you don't want a tax bill. So whatever reason, you want to stay holding on to these investments, but you want to have the risk profile as if you sold off a portion of this to reduce your risk. So that's really where using a debit spread is potentially a strategy that you can use. Now, this is for those of you that are more long-term investors rather than traders, and just trying to protect that larger portion of your portfolio that might be invested in longer-term investments. And this is really where we turn to using a debit spread. Same thing with the debit spreads. You want to use a mechanical approach. We generally go out about 60 days, which in this particular case would be the November expiration. And we would look at buying a 50 delta put option, a slightly in the money put option, and then selling a 25 delta put against it, a 103 put. So a 119, 113 put vertical. This is really the only exception to selling. As we said at the beginning of the session, in the higher volatility environment, it favors options selling. So here, what we're doing is we're favoring buying, meaning the core of the strategy is buying the 50 delta put option. And the only reason that we're selling this option against it is to reduce the cost of buying that put option. Because buying puts when things are on fire is going to be expensive. It's like trying to buy insurance for your house when your house is already on fire or the smoke is already coming out of your house. It's going to be expensive. And one way you can reduce the expensiveness of buying that protection is to also at the same time be selling some protection as well. And when you use these types of strategies, they have very strong risk to reward ratios. Here, I'm risking $500 to potentially make over $1,000. And this is the type of risk to reward ratio that you generally want to use when you're trying to protect your portfolio. You want to spend less to potentially make more if the markets do drop and you sustain larger losses in your portfolio, so that what you paid will pay you a return on protecting your portfolio. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. Perfect. And then lastly, this is the kind of the deeper end of the pool, but some of you here are, familiar with trading index options, and you're familiar with the potential advantages to trading index options, which means that you don't have to worry about assignment risk, and we'll talk about that in a second. But one of the more advanced strategies and a true option seller would take a look at some of these types of strategies. And these are kind of, like I said, the deep end of the pool, is to sell a strangle in this type of market environment. When vol is high, a strangle lets you to take a pure short vol position that's fairly delta neutral. But I'll show you how you can adjust this so that you have a directional bias to your strangle. And use it to your advantage when vol is high. Because when vol is high, a strangle truly allows you to sell that volatility. You're selling an out of money call and an out of money put at the same time. And what you're doing is you're basically straddling the market. And you can basically choose your strike prices based on whether you have a more bullish tilt to the market or a more bearish tilt to the market. And I'll show you here in one second as to how you go about doing that. So here, when you're selling a strangle, the rule of thumb here is you want to go out roughly 45 days to expiration, which is the October 28th expiration. And because we're currently looking at a more bearish market, I'm going to sell a 30 delta call option, which comes out to be a 125.5. That's relatively close to the current price of the stock. So this is a strike price. There's a 30% chance that NDX or Nasdaq 100 will be above that 125.5 strike price. And then what I'm going to do is I'm going to give myself much more room to the downside because I'm bearish on the market. And I'm going to sell only a 15 delta put option. So that's a 106. So think about it. The market's currently trading around 118.5. For the market to go up to 125.5, that's about a $7 move to the downside, to the upside. For it to go down to 106, that would have to be a roughly $12 move to the downside. So you have, not quite a 2-to-1 risk, 2-to-1 move to the downside than you have to the upside. But this is really how you can effectively take a slight, somewhat neutral, but still bearish view here in the broader markets, but truly be selling volatility. Like I said, this is the deep end of the pool because your max gain is limited, but your max reward is unlimited. But the reality is that, when you're trading an index option, or when you're trading something that is made up in this particular case of 100 different securities, you don't have days where the stock gaps up to, 20% or moves down by 20% overnight. It just doesn't happen because there are 100 securities. You've diversified away the single stock risk, which is why we tend to see these types of strategies traded far more in index type products and ETF products rather than in single stock. But this is one of the products where you can look at selling strangles. And even though we call it unlimited risk, what you're really risking is how far can the index move in the next 45 days, which based on historical probabilities, you can calculate a good sense for how much the stock can move. And I'm going to show you this here, just to show you this real quick. We're going to look at high implied volatility strategies using OptionsPlay. And for those of you that have OptionsPlay, I'll show you how to access it. If you don't, we actually automate the credit spread that I just talked about. Both the bullish and bearish credit spread that we talked about. We also automate the debit spread when you click on the bearish tool. When you click on bearish for trading, it'll automate the debit spread. The strangle is where you have to do a little bit of customization. So you can modify, use our strategy constructor. And let's say I'm neutral, I want to short a strangle. So before I was looking at the 122.5, which is the I was looking at the 122.5, which was the 30 deltas. So as you can see on my strike price, I have the strike price, the premium, and the deltas. So the 126 is a 31 delta, and the 126.5 is a 29 delta. For those of you that are asking what is delta and how is it calculated, I'm not going to talk about how it's calculated because it gets into calculus. But what is delta? Delta tells you the probability of the stock being above that strike price at expiration. So the 126 call option, there's a 31% chance that the NDX or the Nasdaq 100 index will be above 126. That's how we choose strike prices, because when you use a probability-based approach, you're going to have a far more consistent process and far more consistent outcome for each of the strategies that you use. So I'm going to use a 126 strike, which gives me a 30% chance that the markets will be above that level. And then I'm going to select that 15 delta, 16 delta here, 107. That's how I choose a strangle here. And that's going to collect $3.25. And when you click on this, you'll see the NDX has to go below 103.75 or above 129 before the strategy takes a loss. That's any loss. That's not even that's just a penny of loss. It has to move beyond those levels. And just to put that into perspective, 129.25 is up here and 103. Well, I'd have to actually make this a little bigger here just to show you where those levels are. 103 is down here and 129 is up here. So the market would have to exceed that level or go below this level in order for this to even show any losses. And even if it moves a little bit higher here, you'll see it doesn't actually have that much in terms of losses. So here, even if it goes up to 135, I'm only losing $616. If it goes down to, let's say, 95, which is substantially lower than what I'm expecting to, I'm only losing $664. Pretty far away from unlimited losses. And this is just showing you, even if the stock makes an extreme move, or rather in this particular case, the index makes an extreme move, in most of the scenario, as you can see, your probability of profit is over 70%. So it really needs to make a big move before these start to show any losses. And the term unlimited throws off a lot of people. You really have to take your mindset out of that a little bit, because the index has to go to effectively infinity for that to happen, or to zero in order for that to happen. And that's just quite unlikely in the next 45 days, especially when you think about the index is made up of 100 of the largest stocks in the non-financial stocks listed on the Nasdaq exchange. So that's how you set up a strangle. And if, let's say, you have a bullish tilt to the market, well, you can just move the strike prices the other way. You would sell the 30 delta put and then maybe a 15 delta call. So that would be the 114, 131. You're basically strangling the market depending on what your views are, how much you think the markets are going to move. If you think it's going to be very bullish, you might move your strikes up a little bit more. If you're very bearish, you might move your strikes all the way down a little bit more. But that's how you can, choose your strike prices on a strangle when you're trading this. So hopefully this gives you some sense for how you can play some of the more advanced strategies that really the professionals trade. And they trade it because, like I said, the unlimited nature is what scares off a lot of retail traders. But if you really understand your risks, you'll see that the market really has to make a big move before you see any losses. And even when it makes a big move, your losses may not be as nearly as bad as you think it is, because it's technically unlimited, but reality-wise, it's pretty far away from that. So hopefully that gives you a sense for the different strategies that you can use in this type of high volatility environment, from beginner type strategies like credit spreads and debit spreads to more advanced strategies like strangles. And just to kind of add on that one more thing, if you like the strangle strategy, but you really hate the unlimited risk nature, you're just not in your nature, or maybe you don't have options clearance to sell naked calls and puts. Well, one of the things that you can do is turn it into an iron condor. So you can sell the strangle and then simply buy further out of the money calls and puts and reduce that overall risk. And that way you can trade a short strangle in the form of an iron condor that has truly limited risk. So that's one other thing that you can do if you are uncomfortable or cannot sell naked strangles. So we've talked a lot about the market conditions. We've talked a lot about the strategies. Let's talk a little bit about index options is potentially a more beneficial product for these specific markets. When we talk about index options, I'm typically comparing ETF options to index options. So most of you are familiar with SPY and QQQ. That's the Nasdaq 100 ETF and the S&P 500 ETF. There are similar type products listed on the S&P 500 index and the Nasdaq 100 index. So today we're talking about the Nasdaq 100. And so what we're comparing is these Nasdaq 100 index options to QQQ, which is the ETF option. And theoretically speaking, trading these two products are completely interchangeable. Meaning if you put on a credit spread on QQQ and use the same expiration, same strike prices on the two products, you'll have the same outcome. You're not going to see different outcomes by trading the QQQ versus NDX. But there are some practical differences between trading the two. There are some major practical differences, actually. The index option is European style and it's cash settlement. And this is extremely important for option sellers because one of the primary risks that you take as an option seller is that you can get assigned early and you can get assigned at expiration. Both of these are completely eliminated when you trade an index option. So like I said, when you're comparing QQQ and NDX or XND, which I'll show you here in 1 minute, the risk profile of the two trades are identical from a trading perspective, but the risk on assignment and exercise are completely different. With index options, there is no assignment and there is no early assignment. So you can basically completely avoid those risks altogether, which can really be favorable for option sellers, does not have to worry about that. Index options are listed on some of the most liquid and widely tracked indices. And what that means is that you diversify away single stock risk. So you're never going to wake up and say and hear that, oh, earnings were really bad and the stock's down 25% like FedEx, or they bought a company like Adobe and the stock's down 17%. That doesn't happen to an index. You'll see a small move in the index if one of the big stocks has a big gap lower, but you're going to basically diversify away that single stock risk, which again favors option sellers. As a seller, you don't want surprises to come out of nowhere. The downside is that you only have about 50 indices in the US that have index options listed. And the secondary, I would say, restriction of index options is that the contract sizes are typically very large and suitable for institutional rather than retail. So that's really why I want to do this session here today, is because not only did I want to show you the products, but I wanted to show you some of the new products that have been introduced that solve this sizing problem. So if you look at the Nasdaq 100 index, it's a $12,500 index. So think about trading a $12,500 stock. if you trade options on it, that's a $1.2 million contract. Most traders don't have that. Even large retail traders don't have that type of capital. So there's an NQX, which solves the problems a little bit in the sense that it's 1/5, so 2,500. So think Amazon before pre-split, still a very large contract. But recently they've introduced XND, which is 1/100th the size of NDX. So basically it's $125 ETF, or you can think of it from a sizing perspective as a $125 ETF, and it trades index options on it. So it gives you a lot more flexibility in terms of sizing, and it's even more flexible than QQQ, because when the XND was trading at 125, QQQ was at 305. So you're talking about ETFs that are about 3 times the size, giving you that flexibility to trade smaller size, whether because you have a smaller account and you need that flexibility, or you have a larger account, but you just want to be able to scale in and out of your positions. XND gives you that flexibility to be able to do so. And these are listed on some of the most liquid products in the world. You know, I get a lot of questions from people asking about liquidity of these types of products. Well, you know, open interest and volume is something that a lot of people point me to and say these have low open interest and volume. Well, all new products have low open interest and volume. They have to start somewhere, right? Every product is listed with 0 open interest and volume. But keep in mind, the underlying security here is the Nasdaq 100 index, which trades over $10 billion in notional volume every single day. So liquidity is not ever an issue in the Nasdaq 100. That's like trying to say that I can't execute an S&P 500 stock. You're just never going to happen. That's just not going to happen for retail traders. So liquidity is there. Volume may not be there, but I promise you the liquidity is there. Trade these products at the midpoint. You never go off more than 1 to 2% off the midpoint. That is your pricing. I've done the research of these products. We've looked at the effective spreads at where these trades execute, and we see that they execute within 1 to 2% of the midpoint, regardless of how wide the bid-ask spreads are on your screen. So it's really important that you not only understand the advantages of index options, but know what index option products are even available for trading that size and fit your portfolio. But from my perspective, the ability to completely eliminate exercise and assignment risk on any short option strategy. So you short a Strangle and it's in the money. You don't have to worry about it at expiration. It just settles into cash. You don't have to worry about taking delivery or having to need stock in your portfolio to deliver. All of that is completely eliminated, which is a huge headache for option sellers. Not only is it a huge headache at expiration, you also have to worry about managing trades more on an ETF option because you're trying to avoid assignment risk. And there's all these rules that we put in place to avoid assignment risk on a credit spread when we're doing it on an ETF. You don't have to do that with an index option. And those are some of the benefits, in my opinion, of using these types of products, even though you have the exact same risk outcome as you do with the QQ with the ETF option. And not only that, these index options have a tax advantage. These are Section 1256 contracts. So you have a tax advantage when you're trading these. 60% tax at long-term capital gains, 40% at short-term capital gains. So if you're trading in a taxable account, these products versus QQQ will give you slightly lower taxes on trading these products. So especially when we're talking about short-term strategies like this, you're almost always going to be short-term in terms of capital gains. This gives you that advantage from that perspective. So hopefully this gives you a good sense for, you know, the products, the sizing, and being able to utilize these products in your portfolio. So if you want to find out a little bit more about these products, you can head over at trade.optionsplay.com/XND. This is where you can find a lot more about these products and kind of the contract specifications. If you want to learn more about that, this will hopefully give you a better understanding of the products. And you can sign up for the monthly newsletter, which will give you insights into what's currently going on with the product. When I host events, when we produce content, you know, when we're talking about short videos, blog posts, you get notified for it if you sign up for that newsletter. There's an option strategy back tester as well. If you want to test some of these strategies on the markets, on specifically the Nasdaq 100 markets, you can do so. And then there's monthly education that we host here as well. And those are all available to you by going to that link here on your screen. So with that, what I want to do is I want to open this up for Q&A. And while I do that, there's a Q&A section and then a chat window. Please type your questions in the Q&A window. While you type your questions in the Q&A window, I just want to remind everyone watching here today, if you don't have access to OptionsPlay, which is the platform that allows you to automatically select the strategies that I showed you with specific expiration dates and strike price already pre-populated for you for any stock, ETF, or indices like the one we're displaying here today, you can sign up for a free 30-day trial at OptionsPlay.com. You can point your phones either at the QR code in that lower right-hand corner, or you can head over to OptionsPlay.com to sign up for a free 30-day trial. You'll get access to the platform, weekly education with Jessica and I, and our chief market strategist, helping you get a better understanding of the direction of the broader markets. I give you a snippet of what our views of the market is. You can get updated of that every single week as part of your OptionsPlay membership. So with that, let's look at some of the questions here. How do you know when to get out of a credit spread? Great question. So normally speaking, we have 3 rules for exiting a credit spread. You have a take profit, a stop loss, and a time-based rule. And the take profit and the time-based rule is because when you're selling a credit spread on a stock or an ETF, you have that assignment risk. And the take profit and the time-based rule is to eliminate that assignment risk probability, or rather reduce it as close to 0 as possible. But when you're selling a credit spread on an index, because there's no assignment risk, the only thing you have to worry about is a stop loss rule. And generally speaking, the rule is if you've lost 100% of the premium that you've collected on the credit spread, you get out and move on to the next trade. That's the only rule that you have to remember when you're using a credit spread on a index option. So hopefully that answered your question, Bob. David's asking, those NDX strikes have no open interest. Hopefully I've already addressed this. Open interest really has nothing to do with the liquidity of a product. Rather, if something has 0 open interest, if the underlying is really what determines liquidity, and we're talking about one of the most liquid underlyings in the world behind the S&P 500. So liquidity is not an issue, especially as a retail trader. I consistently see trades that are trading over $100 million in notional in these types of products. So as a retail trader, when you're trying to trade $30, $50, $100,000 of notional value, it's just not a problem because these are products that trade over $10 billion in notional volume a day. How do you identify option skews? Option skews is really just the difference between the at-the-money strike or the strike that you're selling and the strike that you're buying, right? So you're just looking at the difference between the two. That's your skew. That's how you calculate skew. What are your thoughts for credit spreads of selling lower, further out of the money options to make it more likely to profit, but obviously worse risk-reward ratio? So Daniel, great question. Daniel's question is, what if instead of selling a credit spread like the one that I have here on the right-hand side, which is an at-the-money credit spread, he's saying, what if you go a little further out, right? You get a worse risk-reward ratio. Here, I'm making 222, risking 587, so closer to 3-to-1 risk-reward ratio, but I have a higher probability of profit. And my answer to you, Daniel, is that there's no problems at all of using this. The downside is you have a worse risk-reward ratio. One I don't necessarily think is better than the other. I just think that if you're going to use this type of strategy, use it all the time. And just be prepared that when you're going to win more often, but the fewer times that you lose, you're going to lose larger. It's a personal preference as to which one you prefer, but statistically speaking, one isn't necessarily better than the other. On the hedging and tactical strategy, can you apply the same strategy on individual equities instead of NDX? You can, but generally speaking, most people don't hedge individual securities. Most people tend to hedge their portfolio. Pete, you're saying you mean selling a 30 delta call. If I made a mistake on the Strangles to say buy the 30 deltas, yeah, you're right. This says buy the 30 delta. This should say sell. Thank you so much for catching that, Pete. Why do you prefer NDX over QQQ? So the difference here is this eliminating assignment risk, right? So we're talking about option selling. And when you're selling options, you have exercise risk and you have an assignment risk. And you also have the tax advantage. Those are the three primary reasons why in this type of market environment, when you're selling options, using an index favors using the QQQ, because you're going to get the same dollar amount outcome between the two, but NDX provides you with more flexibility in terms of contract size because it's a smaller contract. You can trade 3 XND contracts, which is the equivalent of 1 QQQ, but you can't trade 1/3 of QQQ. So that's the flexibility that you get in sizing. You eliminate all exercise and assignment risk, and you have tax benefits. You have to, I can't tell you whether or not that's the right mix of products and risks for you. I'm here to educate that these are products available for you out there, and these are the benefits. How much collateral is needed to write a short strangle? So great question, Tom. That's each brokerage firm is going to be a little different. So I would suggest that you go to your brokerage firm and ask them specifically on an index, what is their margin requirement for selling a strangle? They'll be able to tell you. But as a rule of thumb, 20 to 30% of the notional value of the contract is a good starting point, just as a back of the envelope estimation. Jonathan, I'm reading your question, but it's a very long one. So if you don't mind sending us an email at info@optionsplay.com, I'm happy to address it because it seems to be, more specific to our platform and a specific scenario that you're looking for. So Jonathan, thank you so much for sending that. I would like to address it, but not in this forum. How can I find the company complete 50 index fund list for your website? I'm not sure I understand what your question is. If you don't mind clarifying. What are the other small markets besides X and D? I'm also not entirely sure what you mean by that. Hi, Tony. On a strangle, when do you sell? Very good question. So there's two general conditions that make it best to sell a strangle. We tend to find that after the market makes a very large outsized move, right? That's really when you tend to see consolidation sideways. So after the big move is generally when you tend to find a good time to sell premium, right? So look at this big move, this quick out of the ordinary 3-day move in the markets, provided a consolidation period to sell premium. That's really the type of conditions that you generally see. And also the other thing is just when vol spikes. When you see big moves up in vol, those are your best conditions to sell volatility or sell strangles rather. How do I find the Ichimoku cloud? Deborah, that's a great question. On our platform, you can add it just by going to studies. There's an Ichimoku cloud indicator. Most platforms have it as one that you can add. Yes, this session is recorded, and we'll send you both the slides and the recording afterwards. Yes, I will fix that slide for strangles. When you're selling spreads, you're selling at the money calls and puts. Why not sell a strike that's further out of the money? So the answer is just that when you sell further out of the money strikes, you're just going to have a worse risk-reward ratio. I tend to favor selling something that has a much better risk-reward ratio, right? So we were looking at this where the risk-reward ratio is about 1.5 to 1. If you go further out, you're looking at closer to 2 to 1, right? So you're risking twice as much as what you, 3 times as much as you can potentially make. I don't love those types of risk rewards. We tend to find that, one bad trade tends to wipe out a handful of great trades. And you just have to have one trade where you're not disciplined on, and you end up wiping out a lot more wins. I tend to don't love those odds, in my opinion. I think that we're all human. Sometimes we make bad decisions. Sometimes we don't stick to our plans exactly the way we want to, even though we say we're going to. And this is one way to prevent me from ever getting into that position to begin with, because no matter what happens, the most I'll risk is roughly 1.5 times what I could potentially make. So even if I make the worst possible decision and stay in the trade longer than I wanted to, which I know we're all guilty of, and for those of you that can relate to that, please type 1 into the chat window. I would prefer that my option strategy has a mechanism built into it that already prevents me from, even when I make the worst possible decisions, I'm only risking a smaller percentage relative to what I can potentially make. I know a lot of people favor those higher probability trades. From my perspective, all you need is one trade where you don't stick to your plan and you end up wiping a lot of great trades, on the back of that. So that's my preference. When markets get really volatile, is there a danger of market makers turning off their options tables versus increasing the spread between the bid and ask quote? Really fantastic question from Bill. Bill, we have seen the exact opposite of this happen. Remember, market makers make money when you're trading, and trading tends to happen in more volatile markets. So not only do we see tighter markets when things get more volatile, we see better executions and better fills when things get more volatile. Market makers are in the market of making money, right? And the only way they can make money is if they're trading against the order flow. And they tend to, they make most of their money on some of the most volatile days. So we've done the research, and you can actually see it on the Nasdaq 100 website. If you click on that link that I showed you before, we've done the research. When things get more volatile, bid-ask spreads do widen out a little bit, but execution quality actually improves. Is it possible to have one leg of the spread called away on an assignment? On an index option, no. On an ETF or stock option, 100% it is possible. But it's really on the short leg. The short leg is where you can have it assigned. Does NDX have daily closing expirations? They do not yet. If I'm not mistaken, later in the year, they will have Mondays and Wednesdays. But right now, it's just weekly expirations. Selling straddles, you want high IVR, but also want the straddles to stay at the strike price. Seems like a paradox. Direction and volatility are completely decoupled from each other. Even though you think of them as inversely correlated, they are not tied to each other. So keep that in mind. And, we're not, and the thing about selling straddles, a lot of people think about straddles as individual straddles. Think about an insurance company, right? An insurance company doesn't create a policy thinking that I'm hoping that I'm not going to have to pay out on this policy. An insurance company sells thousands of policies, and they just need to know that at the end of the day that they're collecting more premium than what they're paying out. So when you think about selling straddles, a lot of people think about, am I going to make money or lose money on this one straddle? It really doesn't matter. You have to think about straddles as something that you do consistently over time. And then as you do it over time, you're going to have more premium coming in from the straddles that you sell than the straddles that you lose money on. You have to think about the bigger picture when it comes to straddles. And the best explanation that I can give is think about an insurance company selling policies. They're not worried about individual policies. They're worried about all the policies that they've sold. Are they collecting enough premium to offset what they have to pay out? And that's how you should think about selling straddles, not as individual policies, because no insurance policy sits there and looks at individual policies and says, like, am I going to make money on this one policy or not? They look at it on an aggregate level, and that's how you should think about straddles and strangles as well. So that covers what I have time for here today. I really thank everyone for taking the time out here this afternoon. I hope that this was helpful in giving you a better understanding of navigating these types of markets. It is uncertain, it is emotional, but hopefully this gives you some semblance of rules and strategies that you can use when things get more volatile, and when even things get more volatile than we are right now, and how you can navigate it. So with that, thank you so much. I hope you guys have a great afternoon. We'll send you both the slides and the recordings after we finish here today. Thank you so much and have a great evening.